Welcome to the Infinite Wealth Podcast. I'm Cameron Christensen, along with our co-host Anthony Faso. We just wrapped up our interview with Brandon Miller from M&M Bank, and he is the Director of Life Equity Lending. That was some pretty good stuff, right, Anthony?
Yeah, it was very good.
What kind of takeaways you got for us?
Well, I tell you, before we go into takeaways, and we're going to give our listeners like a little behind the scenes of what goes on here.
Okay.
Right? When we do a podcast, normally Cameron and I will do a awesome interview, right?
Amazing.
And then when we're done, we will talk about what sort of takeaways we had. And a lot of times I have to re-explain like what they were saying to Cameron so he understands. And one thing Cameron said in there when we were going over our takeaways, he goes, "You know what? You can say whatever you want." Okay.
I did.
And the reason why I'm saying that is because you, in essence, gave me permission to kind of say whatever I want.
Yeah, you got a green light.
Okay?
Go for it.
I'm seeing you're getting a little nervous here. Okay.
Not sure where you're going with this.
And I'm going to drop some news on the Infinite Wealth Podcast that has not been made public yet.
Oh, do I know about this?
You don't even know about it.
All right. I'm excited.
Becky does. Becky knows.
Oh,
But you don't.
Yeah. It's all right.
I'm going to be a grandfather.
Are you really?
Yeah.
Oh, congrats,
Sweet,
brother. Oh, man. Awesome, man. Congratulations.
Yeah.
That's exciting.
Yeah, I'm excited.
Yeah.
Super excited. It's going to be a boy.
Is it really?
Not that it mattered, but
Wow.
we're going to have a boy, and we're super excited.
Man, congratulations.
Would you believe he's going to be born on the due date's April 15th? Isn't that kind of ironic?
That is pretty ironic.
Okay, so
Wow.
I digress. I just
Wow.
wanted to...
what an intro. What an intro.
And I kind of wanted to get your recording, so I kind of got your face of beforehand, oh, what is Anthony going to say now? And then, okay, all right.
Well, that's it's usually just some disparaging comment against me, but this was this was a celebration, so I'm excited for you, man. Congratulations.
Thank you. Now, before we go by the takeaways, I think maybe we should explain a little bit about what this concept Brandon's teaching.
Sure. I'll jump in there.
Yeah.
The concept is this. So everyone, at least I'm going to guess that most of our listeners understand what we're talking about is taking a loan against the cash value of a life insurance policy. Now, Brandon does not work for an insurance company. He works for M&M Bank. And so what he is here talking to us about today is that we can take our cash value at the insurance company and put it up as collateral and take a loan not from the insurance company but from the third party M&M Bank. So that's the process that we're discussing today is what are the terms, what are the rates that M&M Bank are going to give us in comparison to what the terms and the rates are at the insurance company when we put our cash value of our policy up as a loan against our policy.
So, Cameron, are you suggesting that we do business with banks, which if you've read, and I know you've read it almost as much as I have, but if you read Becoming Your Own Banker by R. Nelson Nash, one of his 4 rules are don't do business with banks. So how do you justify that?
Great comment. That is a great question. And I would justify that by, number one, I'll say that we hold Nelson in extremely high regard. And I will also say that if we come across opportunities, or what I'd say in this instance is a tool, is we are going to let our clients know about it. Mm-hmm. And it is going to be up to the clients whether they want to implement that tool or not. And so Nelson's, one of his 4 kind of commandments or rules is that you don't do business with banks. In this instance, I think this is a real opportunity where we can actually kind of potentially use this in our favor. So that's how I'd answer that.
Okay, well, good.
Mm-hmm.
What Arad, one of the reasons why he doesn't want us to do business with banks is about the golden rule, right? He who has the gold makes the rules. And when we borrow from banks, they have the gold, so they're making the rules, right? But what I think, and second, part of Nelson's movement was changing the banking system, where, and I don't want to go down the rabbit hole, but when it's called fractional reserve banking, meaning if you deposit $1 in a bank, the bank has the ability to loan out $9 to $10. That's creating inflation, and that's how banks get in trouble. But I think the way we're using it here, we're not storing our money in a bank, right? So they can loan it out 10 times. We're borrowing from the bank. We're putting our money or our dollars in the life insurance company. So if anything, this kind of does the reverse of the fractional reserve banking, because we're not putting our dollars in the bank, but we're taking them out, right?
Yeah.
But and just look, we want our listeners to be financially independent. And that doesn't mean just financially with dollars, but also sense, as in knowledge. We want you to be able to make your own decisions. And if we come up with something, we're going to share it with you. And we want you to do your own research and you determine what's going to be the best for your family.
Awesome.
Now,
I kind of feel like you asked me that question so that you could answer it.
Yeah. Yeah, exactly. Right?
That's good.
Well, I think it's important because I know I had a little concern. Well, we're breaking one of his rules.
Well, that's good. Great question.
Takeaways that I had, I'm going to say, let's not focus on the details or the rates of this loan, because what I want to focus on more is how is this going to help me achieve my goals, right? And rates are part of it, but it's not everything. Like Nelson talks about, it's not about rate of a loan, it's about the volume, really kind of like the big picture, right? So when it comes to these loans, of course it's a loan, so there's going to be rates and so forth, and that's what we saw as the scene. Like that's what you can see of the advantages of using this product, but there's a lot of unseen that goes on. Like for one, particularly if you have multiple policies, you're going to find sometimes it's a little bit of it's not as convenient, because if you might need one loan, but you might have to draw it from 3 or 4 policies. So then that's 3 or 4 loans that need to be signed and tracked. What I like about this is it streamlines it. The ability to keep track of your loans and also get access to the loans is much more efficient. I mean, imagine he's going to tell you that you can, with this product, you can get a checkbook.
Yeah.
I mean, so in essence, you're getting a checkbook that draws against the cash value of your life insurance policy.
Don't worry, guys. We take a little segue in there and actually explain to you guys what a checkbook is, too. I was joking. I haven't used a checkbook in 20 years.
Yeah. Okay. All right. They're not all funny, but okay. Let me get back on track. But this, I think, if somebody's practicing infinite banking, that this makes this easier for them to track and to get access to the money. And one thing we haven't talked a lot about is that companies being direct or indirect recognition. And just in summary, what that means is that if it's a direct recognition company, they directly recognize if you have a policy loan or not. And if you have a policy loan on a direct recognition company, the dividend may be lower. So, but if you're working with a direct recognition company and you're using some like these cash value lines of credit, you technically don't have a policy loan. So this is why another reason why a direct or non-direct company is really not as big of a deal as some people may think, because this, in essence, kind of makes it non-direct.
Great
What
points.
takeaways did you have, Cam?
The first one was probably this is really just a tool that I kind of touched on, right? We can use it when there's an opportunity to use it. And the other one would be, man, when he talks about in the second half of this interview about the ability to take a loan against a PDF account, is you and I have had this conversation again previously, and I think the words that we used were game changer. Mm-hmm. And that's huge. It's a great opportunity because one of the biggest obstacles that people have when they start to look at this infinite banking strategy is the idea of a slow start, which means that we've got some costs up front early that start with the policy. And utilizing some money going to a PDF, and we explain what it is in the segment, but it really eliminates that and allows us to have access to quite a bit more capital early on and instantaneously through a checkbook that we can use for pretty much whatever we want. So I thought that was going to be a huge piece to it. So I look forward to you guys listening to this, understanding when and where it'll be a good fit for you guys, and enjoy this episode. Brandon, thank you so much for joining us today. We appreciate your time. Let's jump right into it. What do you think?
Yeah, absolutely.
Awesome. If you could start, we've had some conversations, but if you could kind of clarify what we're going to be talking about today. We've heard it called a LILOC, life insurance line of credit, and I think you guys call it life equity lending. But if you could just give us maybe a broad definition of what we're going to be discussing, that'd be great.
Yeah, so I think in most simple terms, when I talk to a prospect, referral through an advisor, an insurance policy holder, typically we're just talking in the sense of home equity line of credit, the same functionality. We're just using your cash value of your whole life insurance to secure that life or that line of credit for the client.
Okay, so how does that work?
Yeah, so take that a step further. We take and place a collateral assignment against cash value within policy or policies. We can use multiple policies to underwrite a single line. We place an assignment on the policies, write a line of credit that becomes a revolving renewable line of credit that the client has access to through multiple ways: checkbook, ACH, wire transfer capabilities, and then they have access to their cash instead of reaching out to you guys, the advisor, needing to take a loan from policy. I mean, let's be real. If you wanted to be bankers, you would have signed up to be bankers. And so you left that job to me, and we try to handle that well. So we set up the line of credit. We become the banker. But really, they're still banking on themselves. They have the checkbook in hand. They're able to take and write out of that up to the maximum available within the line of credit and have full capability or full use of their cash value in the line.
Now, when somebody takes a policy loan, like one of the key things, a key point of an infinite banking concept is you're not taking a loan from your policy, you're taking it against your policy. The insurance company is using your cash value line of credit, using your cash value of your policy as collateral. And then you're actually borrowing money from the investment arm of the insurance company. So what we're doing here is very similar, right? Now, the bank is using the cash value as collateral, and you're borrowing money from the bank. So correct. How is this different from a policy loan?
Yeah, well, I think the key is a loan versus a line. You've got a loan, you've got to take a specific set amount, and it's outstanding. Oftentimes, what I find is the clients that we encounter and that we work with are oftentimes using this on a revolving cycle. So many times they come to you, they get a loan, but then they have a cash event, a liquidity event. They pay the loan off, and then it may be weeks or months, maybe years, but there's a frequency of them borrowing again from the policy and taking another loan. For us, it's establishing it as a line of credit. So in the best interest of the client, we make our money is obviously what's outstanding, but the benefit to the client is they can have a large portion of their cash in policy available in a line of credit, and the only cost of borrowing is based on the outstanding balance. So in a cash event, a liquidity event, they pay the line of credit down. When they need to borrow, they write a check back out or ACH the funds back out, and there's no cost of borrowing in that interim period of the unused balance. So their access to the cash value in a revolving renewable line of credit versus a policy loan gives them flexibility to use it in many different areas on an ongoing basis. Over and over again, they want to borrow at their capacity. And again, not pulling you in, not that we want to admit the advisor, because that's still where the relationship lies. Mm-hmm. And you don't want to be in the loan business. You want to be in the insurance business. And so for us, it takes you out of that piece of it to be a partner to you in your practice, helping your clients achieve success with the cash value they're putting into the insurance that you're working with them so diligently on the planning side.
Okay, so what's the advantages of going through a bank versus the insurance company?
Yeah, great question. So a lot of advantages there. I mean, again, go back to the line of credit, the functionality, the ease of use. And then you go to what's most important to people. I mean, at the end of the day, it boils down to money. How much am I paying to borrow? What's it costing me to borrow if I borrow from the policy? What's it costing me to borrow if I borrow through a bank line of credit? It rarely makes sense other than a very high use client. It rarely makes sense to pay a higher interest rate. So for us, being able to most oftentimes yield a lower interest rate, the client has access to their cash at a lower cost while still keeping the policy fully intact, not borrowing directly through the carrier. Everything in the policy is left intact. Again, we don't change beneficiary or owner. We only go into assignment. So we're able to leave the policy as you planned it with the client, the way you put it into underwriting and put it in force with the client, and then they're able to borrow that at a lower rate. Typically, that arbitrage is somewhere between 50 to 150 basis points in the rate environment that we're in today. But I've seen it spread even further than that over the years. So it just depends on the carrier, depends on the policy type and what loan rate is associated to the policy in which they're borrowing from. Very few cases where it's made sense, but it has, mostly with real estate investors that are constantly turning properties and leveraging the cash, that they'll even pay a higher interest rate with us to have a line of credit versus a outstanding loan.
Okay, perfect. Because I'm glad you brought that up, because we're constantly talking about, we need to look at the whole picture. We're not, a lot of times everybody's focused on rates. You know, what's the rate of this credit card? What's the rate of return here? But we want to teach our clients, we want to think about volume, right? The amount of money flowing through, and really how much money are we going to have at the end of the day? So so what I'm hearing is typically getting a loan through a bank is going to have a lower interest rate.
Correct.
Okay, right? Okay. Which is great, but that's not all of it. I mean, that like, to me, I'm not chasing rates. If you're half a point or a point less, like, there's got to be more, right? So what are some of the other advantages besides a lower interest rate?
Yeah, I mean, again, it goes back to carrier specific, how the policy is impacted when you take a policy loan, what the recognition is. And then having a banker that's on your side to work with you from a banking aspect, while still being mindful of the planning process that you as the advisor and the client that we're working with have gone through. The line of credit and the accessibility, having a checkbook in hand, which, by the way, we're one of the few banks that does a checkbook. Many of them still require an email with wire instructions, and the only way to have access to your funds is through a wire. We feel fully secured in these because of the carriers that we underwrite and cash value that is backing our loan. So we put a checkbook in the client's hands. Having a checkbook to be able to make a quick transaction is very important for most people who are leveraging the cash in their policy.
I got a question. What do most of your clients look like? Do they fit a certain mold?
Yeah, it's a good question. I mean, and the easiest answer is no. We have clients across the spectrum. So M&M, we've been in this business now for over 18 years. We've got over $450 million outstanding in these life equity loans. This is a business that we've committed a lot of our asset and our work to. In fact, we have a team now of 8 of us that are in this department alone. This is the only work we do, and the clients really run the gamut. I mean, they are anything from real estate investing to buying a second property to operating a business. In this economy, a lot of business operations, they've just had to pull capital to keep operations up and running. Whether they're looking, whether it was for a wedding, for school, for a car. I mean, it really is across the board. A lot of business owners, a lot of folks who are looking to invest, a lot of folks who are looking to leverage the cash into an alternative investment, other policies, whatever it may be that they're looking to pull out. But there's no ideal client, if that answers it the best way.
No, perfect. That's kind of what I was looking for. I was going to give you a kind of a specific scenario, and let's say I've got $100,000 of cash value, and I pay a premium of 20,000 and my cash value increases to, let's say, 130. How is that handled internally by you guys? Because I'm assuming my line of credit starts at 100, or maybe you can touch on the percentage of cash value I can borrow against, and then also how that is handled once I pay a premium.
Yeah, absolutely. Well, first, I really like the math of that policy. With 100,000, you pay 20 and you got 130. We're gonna have to talk a lot more.
I know where you can get one of those.
Yeah.
On that design. So, but yeah, so let's just say year one that we write the loan, not year one of the policy necessarily, but you got 100,000 cash. We write the loan for roughly 95% of your cash value. We base it on the available for loan amount, and we do it at 98% of available for loan. That's the carrier's loan availability. And so let's just take 98% of that 100,000. We write 98,000. You have that a year later or sometime within that year, you've paid your premium, and now that cash value has jumped from 100 to 130. It's a simple change in terms for us. We get an updated policy report, send that to the underwriter. If it's outside of 12 months, just to make sure our files are up to date for audit purposes within the bank and our lending requirements, we get an updated application on file. But once we do that, we send a simple change in terms as soon as that's signed, because we've already got the assignment. So as soon as it's signed and received back, we increase that line amount to the new loan rate. The difference of that, let's say you got 100,000 today in a policy, but you add a new policy with 20,000 in premium, and you're wanting to add that to it. Same thing. It just can take a little bit longer to get the increase effective because we've got to get the assignment on the new policy.
And you mentioned there isn't a max as far as the number of policies you can use. You can use as many as you want.
Yeah, so we'll take across the board. And I think our largest right now is 28 policies with one client, and we have some that just have the one. So as long as they're whole life policies of some form or fashion, we're gonna take combine them into one line of credit and pull on that. I mean, to where that 28 comes in with one, but oftentimes where we see two or more policies is oftentimes a husband and wife or business partners. And they're jointly applying for a line of credit. And so we'll do that as well. We'll take the joint application and merge those policies into one line of credit.
Okay. So now once somebody's established a line of credit, are there any penalties or fees or anything associated with it? What I'm specifically thinking of is like an early payment penalty.
Yeah, good question. So let's just start at the top. I mean, there's no application or initiation origination fee to the loan.
Okay.
We do not charge an annual fee on the loan. And then we do not charge a prepayment penalty. So while we only require interest-only payments throughout the year, and it's quarterly for all of our clients, you can make principal reduction payments at any time. And that's a simple ACH form to us that allows us to draw the funds in and a principal reduction. So again, going back to earlier, it's in the client's best interest when they can pay it down, pay no interest on what's not being used. And then when you need to leverage it out, pull it back out.
Okay. So for example, like a family, let's take me, I have policies on multiple people in my family. So I can do one line of credit against multiple policies, no matter who the insured is.
Correct. Okay. Yeah, really looking at the owner. So, but insured doesn't come into play as much as the owner. Who owns the policy? Because that's, as you know, that's the decision maker. And so, again, in your case, you own multiple on all family members. You own some, your spouse owns some. We just take and merge those together into one line. We just have a co-applicant on the application. In the event that you want them separate for whatever reason, you can do them separate. But oftentimes we just merge those into one line, blend it all together. And then we just get the application assigned with an applicant, co-applicant. And then we have assignment forms respective to who owns the policy.
Okay. To me, one of the biggest advantages of using this life equity loan is if you're a power user, somebody who has multiple policies. Like sometimes if I'm doing a big deal, maybe I need $100,000, but I mean, I need to take 20 from this policy, 30 from this policy, 10 from this policy, which means I might need to hit 4 policies. And since I'm in the community property state, my wife needs to sign all
Yes.
4 of those. And then we need to submit those forms. And then it's taken about a week to get the money direct deposited in our account. Quick transition. How quickly, once the account's, this line of credit set up, how quickly will they get the funds?
Yeah, so I mean, let's just walk through the timeline and let me answer that with a long answer. So today we get an application. You submit your application. You have your assignment forms with it. We get your policy detail reports. Most of the time, you guys can provide those on behalf of your client. There's some carriers we have to reach out to assignment form and get the policy detail report. Once we have all the documentation, I get it to my underwriter. We typically have a response within 1 business day, oftentimes same business day. And they'll approve the loan. Because some carriers still require a notary on the assignment forms, we have to send those. We still send our docs out via FedEx overnight instead of using DocuSign or electronic format. So we send those out as soon as the approval's done. They go out within the next business day. The client signs that, sends it back to us. We get it back. We submit it to the carriers. That's where we lose control of the process, in the sense of I've gotten an assignment same day, and I've gotten an assignment 15 business days later. We try to stay on top of it with the carriers. We work with you as the advisor to help your client get it moved faster. But in the perfect world, once we get that assignment, as soon as we're notified, we can fund the loan immediately, and access to the funds are available immediately once it's funded. So perfect world setup is less than 21 business days start to finish. But I've had some that have been 7 to 10, and I've had some that have taken a little over a month.
Okay, once it's set up, and so I've been approved, and then, but I didn't pull the entire line. How quickly will I be able to have the money ACH or wired into my account?
Yeah. So once we fund the loan and we can wire funds out same day, we can ACH out funds same day. Checks take us 10 to 12 days to get to you because they're cut at the time that the loan is funded. They're sent for processing. So we can have you fund same day.
Okay. So what I like is, if I do a policy loan, going back to the example where I'm pulling from 4 policies, I have to file 4 policy loans, and it's going to take about a week, which I'm not complaining about a week. But I think one advantage is using this type of loan is we can get the money faster, whether we do the ACH or wire. Let's just say next day. Okay. But also having that checkbook, right? Because we believe that we're in denial about the recession this country's in. Like the stock market doesn't show it. Politicians nobody's talking about it, but you start looking at the numbers. I mean, people are going to they're getting behind on their utility bills. They're behind on their rent, and there's been these moratoriums where people can't foreclose. And once they do, I feel things are going to start being apparent. But what that means, what we have to think, we talk about it all the time, is having a positive mindset. Like one of the great guys in the industry, Van Miller, always talks about there's not good news or bad news. There's just news, right? Any sort of news, it is what it is. There's going to be some good things. There's going to be some bad things. And what I'm seeing with this recession, there's going to be opportunities. So, and you hear me say all the time, the larger the opportunity, the smaller the window to take advantage of it. So we need to be able to have quick access to cash, like being able to streamline this process. For one, it's easier. I don't have to get my wife involved to sign these, but I can get the money quicker. And when these opportunities come, I'm going to have that confidence where I can take advantage of those opportunities. So
absolutely,
to me, the liquidity is streamlining, is advantageous. Being able to consolidate multiple policies, right? Because then also let's reverse the example I had. Okay, now I have the $100,000 back. And I'm like, well, where did I take it? Well, okay, 30 here, 20 here, whatever. This kind of streamlines it. So anybody who's actively banking on the regular basis or flipping property, I mean, the ability to write a check, I think sounds fantastic.
Absolutely.
Yeah, and to think about, if the client only does that one time, it's probably not a nuisance to the client to sign 4 forms, have their spouse sign 4 forms. But if they're doing that constantly, it becomes a challenge.
Sure.
You know, and that just, it delays. To your point, it's you know, the ones who will be able to seize opportunity in this down economy that I agree with, that is not showing what it really is yet, are going to be ones who have quick access to funding.
Mm-hmm.
There's a couple of things you said there is that I want to ask you on is, what about the communication? So once somebody's drawn on this line of credit, what type of communication is it coming from you guys? Do they need to inquire about future balances, those things? How does that dialogue work between you and the client?
Yeah, I mean, typically once we get the introduction, we get, you know, I jump right in. I try to be quick, take care of it for the client. We communicate through email, through phone, whatever's best for the client. Everybody's different, both from the advisor side and the client side. We get them the application, we get them the assignment forms, the docs that we need. We get it submitted. We're in constant contact with them. Once they're a client, they have access. So I have a team of there's 8 of us on the team. 3 of us are out in the field. The rest of them are on the servicing side of this product. And so they're available, email, phone call, to help with the servicing needs that are there. And then annually, you know, we do an audit. If let's just say you set something up today and 12 months from now, you've used it, we haven't heard from you on an increase, we're constantly looking. Again, for us, I mean, you know, there's no cost on the account other than outstanding balance. So if I find somebody, let's go back to your example, if I find somebody that had $100,000 cash value and we wrote the line and they have 95% of that outstanding on balance, well, I know cash has grown. You've paid premiums, dividends and cash value growth has occurred. Well, I'm gonna reach out and find out if we can go ahead and write an increase. You may have needs to access more capital. And so we're typically going to be proactive. That's what part of our team's role is they're working the current portfolio to make sure that we're looking at who is utilized, who is past that year mark that we haven't underwritten an increase in the year for, that may need an increase to take place, and they just haven't thought of it yet. But the thing you don't want them to do is get to a point they need it, and it takes a week for them to have to get it.
Yeah. Is there any sort of credit check that comes along with this?
Yeah. So how we work, and every bank's a little bit different in this space. Most of them report these lines to credit bureaus as a debt service. Our take has been it's cash secured, so we don't report it. However, we do an initial inquiry with TransUnion. We do a global inquiry, and we're looking really for specific, or more specifically, we're looking for lien or judgment that would supersede our assignment. So federal or local tax lien or judgment that is really the only risk to us in this setup with these cash policies that would supersede our assignment position. And so outside of that, you know, yeah, we look at the credit report, make sure that it's not somebody that's just absolutely terrible, but we just ask questions. And so our stance with the cash secure is we just don't need to report this as a debt service to mess up future debt to income ratios and so forth. It wouldn't show in the policy loan. Why should we show it in the bank line?
Now, how does that hinder somebody's credit score if you guys are running this check?
Yeah, I mean, there's going to show an inquiry, and that hit will have some impact. It varies across the board based on what their credit is and what else they've been applying for credit for and how many inquiries are out there. So there's going to be a short-term hit because of an inquiry listed, and it is a hard inquiry. For us, it's part of our fair lending process that we're running credit across the board. It's also, again, making sure that our assignment is secure, so that way we don't get into a legal issue in the event that somebody comes after a lien or judgment out there. And it really what it boils down to, and where we base our relationship, while our loan relationship is with the policyholder, the reality is our relationship is with you guys. If we don't have the advisors out there working with us and referring their clients to us, then we don't have the portfolio that we have today. So if we don't do our due diligence and make sure that we don't come into a position that impacts the status of policy and have to make a decision that impacts the planning you've worked hard to put into place, it impacts all three parties, and we just don't want to be in that position.
Now, I can see having that credit check being one disadvantage of using this type of product. Are there any other disadvantages that our listeners shouldn't be aware of?
Yeah, I mean, it's one of those where if it sounds too good to be true, it probably is. In this case, it's not. There's not many disadvantages. I think that the credit check for some comes into play. I think in my 4 years of doing this, I've lost one deal that was just absolute no, that they didn't want a credit check.
Mm-hmm.
It hasn't impacted too many clients through the years in our case. The other would simply be, there's two that come to mind. If there's a desire to make a change to policy, we have to sign off on it. We don't typically run into any issues that we wouldn't sign off on. It's just, it goes back to your example earlier. Somebody else has to sign off on a policy change. We have to give approval for dividend change, for status change, anything that changes in the policy, we have to be made aware of, and we have to approve it as a signee. And then second, there's a quarterly interest payment from the client that's required. We do that on January, April, July, and October 15th of each of those months for all of our clients. And so they have to pay a quarterly interest payment. Now, the good news is, just like within the policy, they can self-absorb it into the line of credit. So they can pay that through a bank draft. They can pay that through a statement and them mailing a payment to us, or they can pay it through the available balance, essentially rolling it into the principal balance of the line of credit. That's assuming they have availability there to do that with. Okay. So they have it function the same way it would in a policy loan. If they didn't want to pay a physical payment out of their cash flow, they can have it absorbed into the line of credit.
Perfect. I would say our kind of thing is, if something looks too good to be true, we need to ask more questions.
Yeah.
Sometimes they are, and sometimes they aren't, right? So, but what about any disadvantages or risk, as we're assigning the policy to you guys? I mean, what is the risk there?
Yeah. So, the good thing is you're not changing beneficiary, you're not changing ownership.
Right.
It is simply just a party that is not in control, but eliminates full control of the policyholder in the sense, again, of policy changes that would impact the cash value of the policy, that could impact the line of credit. What happens in the event? Let's talk about worst case scenario. What happens in the event of death? Well, the benefit is paid out to the beneficiary and the bank. We settle the loan. The remaining funds are passed through as they would with the same tax status to the beneficiary. It's just got to be duly written. What happens if the policy has to be surrendered? Well, we've got to have it settled. So if that's not done prior to, if a policy loan is not taken and approved to pay us off so we can be out of assignee position so the surrender can be simple and easy, then in the event of surrender, the cash value is going to be made to the owner and to us as the assignee jointly. We settle the loan, the remaining funds go back to the owner of the policy at that point.
Okay. What if, say, we change our mind, or, we don't want to do this anymore, or interest rates at the bank are higher than the policy loan, or whatever the or is? We're like, you know what? Time out. We don't want this anymore.
Yeah.
What happens there?
Yeah, real simple. So we leave room. That's why we go 98% of available for loan amount.
Okay.
Or to just sign off on a loan form from the bank. They send us a check to pay us off. With that, we release the assignment. The loan is back to the carrier. We're out of assignee. If there's no balance outstanding, we simply release the assignment and close the line. So it's a very quick process.
And I would say, because we're working together on one of my policies where we had filed, I believe you had filed the assignment, but then we're going to move the policy. We're going to 1035 the policy over to another carrier. So you had to unwind the deal. And I would say it went very smooth.
Well, I appreciate that. You try to start us off with a little complicated one just so you could get your
I know. Yeah.
Hopefully we passed. Our team is pretty good.
I always like to be the first guinea pig. Like if I want to have my clients do something, I want to do it myself. But Brenda, I can see the risk is, well, what happens if we pay this loan off and you guys don't release the assignment?
Yeah, I mean, I think that's a far-fetched scenario, but we've got to answer those questions. I mean, if we don't release the assignment, I mean, there's some forcing that can happen there, but our loan docs very explicitly explain and spell out that our loan is based on the line of credit against cash value. If we're requested to release the assignment and the loan has been settled, whether it's settled through the carrier, whether it's settled through the client directly, whether there was no balance, it's our obligation, our responsibility to release that assignment, to sign the assignment release form and move forward. We had this scenario prior with a client who would not sign the appropriate forms. And it ended up with legal team and the carrier, they were able to process the form through. So the same thing would happen in the sense that if we didn't release, 18 years, we've had to release some assignments. We've never had an issue. Project that being an issue in the future. Why would we not release an assignment? Well, there's an unpaid balance. That's the only reason that would keep us attached. We don't want to hold an assignment on a policy and leave a line of credit open that's unused and requested to be closed, because that ties up our reserves. So for us, we want to put that money to use somewhere else. So it's in our best interest, if the client is moving on for any reason, that we get those funds cleared up and assignment released as soon as possible.
Now, Brian, you and I have talked about this. I know you and Anthony have as well, but are you guys willing to loan against a PDF, a premium deposit fund?
Yeah, it's a good question. I mean,
let's explain what a PDF is first.
Sure. PDF is where a client will write one check, and it'll go into what's very similar to a CD account at the insurance company. Well, they'll pay you assigned interest rate. And so they will use that PDF to pay premiums over a specified number of years. So let's say somebody writes a check for $100,000, it goes into the PDF, it earns 2%, and then over the next 5 years, it pays a premium of $20,000. So what we were just discussing was using you guys to take a loan against cash value instead of taking a loan from the insurance company. And now what I just asked is, are you guys willing to take a loan not from the cash value of the policy, but from the value of the premium deposit fund?
Yeah, so the answer is yes, we will. We've done that with several carriers on numerous occasions, but we've also run into carriers that won't assign the PDF. And so depending on setting that up, you just want to make sure that it's with a carrier that will have that assignable. There's carrier, for instance, that I can think of that they don't include it in the cash value on the policy status report, but when you get the premium deposit fund report, it's the same policy number, and it shows it as an extension. And in fact, the same assignment form covers those funds. So many carriers have made that very easy, and they are willing to assign that as part of the policy assignment. But it does have to be noted. Other carriers do have alternative forms that they require for the deposit fund. And then there's just carriers that we've run into that won't do it. So it's again, making sure in the planning piece that the carrier will do it if that's the route the client's wanting to go.
Awesome. Thank you. And when you're calculating the amount that you'll loan against, how do you derive that amount, including the PDF and the cash value?
Yeah, so since we write our loan on a 5-year term, and when I say that, again, it's revolving renewable. We just, if we don't hear from you in 5 years for an increase, at 5 years we're going to re-underwrite the loan to be in compliance. And so the same when we write inclusive of a PDF fund, we write it in a 5-year chunk. So let's just say that there's 100,000 in the PDF, and year one there's 20,000 in cash value.
Okay.
Let's say in year two there's 80,000 and 35 in cash value. So there's a little bit less total cash. We're going to find the low point of the 5 years and write it based on that. And then let's say at year three, it goes down to 60,000, but there's 165. Then that's when we could look at an increase, because there's actually a little bit more cash in there than what was in the prior years. So we're going to find the low point, which is typically year one, sometimes year two, depending on the structure policy. We're going to find the low point, and we're going to write the first year, or the initial underwriting is going to be based on that dollar.
Great.
What if a policy is owned by a business?
Yeah. So owned by business, we do those frequently. Owned by a trust, we write all of that. Owned by a business does require a little bit more documentation. It's going to require us to obtain the business formation documents, Secretary of State documents, tax ID information, and then of course we have to find out about beneficial owners under all of the new compliance within the banking world. So anybody that is a beneficial owner of the company would also be listed on the application as a co-applicant, and the business, of course, being the primary applicant. So we can write those. They typically take a day or so longer, because we just have to do the back end research inside the business docs. If it's complicated within its structure, we have a legal review team that will review that legally. Trust, we review those legally to make sure that we've covered the basis on who is capable to borrow. Is the trust capable to enter into a borrowing relationship, and so forth. So we look at all those factors, and we can get those policies underwritten typically just as quick, maybe a day lag in there.
Great. Do you have a minimum or maximum on what you'll loan against?
I was just going to ask the same one.
I beat you.
Yeah.
One
So our sheet rate on our product page it's stated at 60,000 minimum, which is pretty much industry standards. I mean, that's what you find across the board. However, you guys have some good clients, as all my advisors do, that may be in year one and don't have 60 in. So what I'm really looking for is if somebody has one or two policies, 20, 25,000 plus, we're willing to get those deals across the table. We can help your clients as they're starting. They're gonna stick with us and let us help them as they're much deeper into these. We can also, as the advisor, we can help you with your smaller clients. We can help you with your larger clients. And so I try to be a one-stop solution for you across the board with the client base that you're working with.
Okay, great. What are the typical terms? You had mentioned like a 5 years line of credit. I guess I'm kind of answering this. Interest is due quarterly. Okay. Anything else we're missing in regards to the terms? Well, let's talk about rates a little bit.
Yep. I was gonna say that's really the only other piece in terms that really matters to anybody. Yeah. I mean, so our rates are based on 2 tiers. And then we have a lending floor. So our rates for clients up to $250,000, that's the commitment amount. That's not the outstanding balance. So if you've got at 98% available for loan, if we can write your line of credit for $250 or up to $250, it's at prime. So $20,000 to $250 at prime. Once you hit the $250 and above point, we're at prime minus 50 basis points. Now, this low interest rate environment that we're in, that's unprecedented, not been seen in a while, it has forced all banks to call a floor on their lending platforms, because prime today it's 3.25. If we went prime minus 50 and we're at 2.75 on a $250,000 loan, we're at about a 75 to 100 basis point loss on cost of funds to the bank. So we're at our floor today, which is 3.95%. With the projected long-term low rates, we are monitoring that floor to see if we have room to make a move to a lower floor rate. And if we do, I would assume that would happen in early 2021. But it's not a guarantee, because at the points that rates start to shift back up, tightens those margins in, and we just got to make sure that we maintain a profitable position in a low rate interest environment.
Okay. Now, what happens if somebody can't pay their premium? Right, so you have this line of credit, but their premium comes due and they can't make it.
Yeah, so I think, first it goes back to leverage. Are we fully leveraged on the line of credit as it is today?
Okay.
Let's look at the IFL together and see what cash value is going to be on the other side of the premium. If cash value growth exceeds premium costs, then we may be able to short term that loan, because we know as soon as it's paid, cash value is going to increase and it covers the line. Worst case scenario, if it's a short term cash play and they have to make the premium, we increase the line and they draw it back out. I've seen it both ways.
Okay.
Simply because of the carrier, the way it credits, and so forth.
Okay, perfect.
I think we've got them all.
Okay, well, how about this? What if we have an existing policy loan? Can we still get this line of credit?
Yeah, so the majority of our lines of credit are established with existing policy loans.
Yes.
So step back to the question earlier, how quickly can they receive funds? So at the point we get your documents back and we submit for assignment simultaneously, because we know we're going to get the assignment with the carrier. It just, how long is it going to take them this time? We go ahead and get the payoff of the loan. We go ahead and wire funds out once the payoff is received, even while pending assignment. So we go ahead and pay the loan off in process. And then once the assignment is confirmed, we release the additional funds. So the majority of our loans are typically already utilized within the policy itself.
Okay. So in essence, if somebody has an outstanding loan, we're just going to kind of like refinance it with M&M Bank.
Absolutely.
Right?
Absolutely. Yeah.
Okay. Perfect.
Awesome.
And I'll add to that, while we're talking about policy loans, because I get this question often, and none of your clients, they're way too smart. But oftentimes people say, well, how often, or what's the issue if I still borrow from the policy itself? Well, you can't. Our lending agreement prohibits that. If you die, that goes back to the piece where we have to approve for a loan to go through on the carrier, other than an automatic premium loan, which we only get notification of, and that's where we do an increase to pay it off. But if a client requests a policy loan and you try to submit for it as the advisor, or they call the client service desk and request a loan, the form is going to have to be sent to us to sign off on a loan. Well, at that point, we're going to decline it. We're going to have a conversation with the client advisor as to why they're trying to borrow from the line of credit.
Right.
Oftentimes that only happens when the line is fully utilized with us and they're wanting to double dip on their funds. And so, we just have to let them understand that the line of credit prohibits that. And even if they go back to the carrier, their line of credit or their availability to borrow is going to be zero, because they're max utilized on their line of credit with us that would have to be paid off. So again, probably not going to run into it with your clients, but we have run into it across the board where somebody tries to borrow from the policy outside of the line of credit.
Okay, so I know you kind of want that minimum line of credit to be around, was it 65 or 60?
60.
Yeah, that's 60.
Okay, all right. So do we need to, or let's say, for example, I'm going to get this line of credit. Do I need to draw the whole 60, or do I just need to get approved for 60 and I can withdraw as I need to?
Yeah, so we don't have a required minimum draw or required initial draw. So whatever we establish a line for, you just have availability up to that point. But when you get a check, you can write a check for $1, or you can write it for the maximum amount available. So there's no required draw on that. If we set it up for 60, they can draw whatever their need is and have the rest available.
Okay, Brennan, you've been very helpful. Before we wrap up, is there anything we missed? Any questions Cameron should have asked and didn't?
No, I think you guys covered it well. I think the relationship that we've been able to jump into over the past several months, and in in a concept that hasn't been norm for your planning practice is been really fun to see evolve. And I think for your client, it really gives them a great opportunity to leverage the capital in a different way at a better rate than what they've been able to in the policy itself. But the great news is they're able to always go back to the policy. Higher rates, issues, whatever it may be, they're able to go right back to the policy, and it doesn't change the planning that you guys have worked hard together on, you as the advisor, them as the client, to look at their long-term financial picture. And so, I think we've covered the bases today on it. I think it's just, next steps is the folks that are out there that are sitting with policy loans today, they're prime candidates. The folks who are looking to leverage opportunity in this economy that we're in, they're prime candidates. And then again, there's no picture perfect client. It's really across the board. If they have cash value, that is the picture perfect client.
Well said.
Yeah. Brandon, thanks, man. Really appreciate your insight on this kind of tool that we can use. And we look forward to continuing to work with you.
I look forward to the work together with you, your clients, to being an asset to the planning process and to see what we can do as we move this forward.
Awesome. Thanks, Brandon.
Awesome, buddy. Take care.
Thank you.